What did I say last time? I said this exact point was like people will buy the dip on something that's down 50%, but if the total drawdown is going to be 70%, that means that when you buy the dip at 50% down, it has another 40% to go.
QQQ, I'm underwriting QQQ breaking 400. I think there's going to
I
be a
think
lot
so
more
too.
pain.
Hey everyone, just want to give a shout out to our sponsor, ValueSense. The landscape of investment research is undergoing a massive shift. Sentiment tracking, automated valuation models, and real-time fundamental analysis are no longer the domain of hedge funds alone. ValueSense is breaking down these walls, ensuring that sophisticated, data-driven strategies are no longer monopolized by the financial elite. If you are interested in getting a leg up on the competition, check out ValueSense at valuesense.io. So let's take a quick look through their platform. You can basically find any stock you want and take a look at their fundamentals, all sorts of momentum factors. Let's take a quick look at Microsoft. Let's see. Okay, gives you a quality rating. Nice to see. So you could see revenue growth. It's giving you historical averages, operating income growth. Wow, charts over time showing you gross profit growth, revenue growth. Basically, you can just use this to do deep dive research on any company that you're interested in. And there's going to be ways to create reports and compare across different stocks. And it's a great tool to basically just start doing your research and finding potential opportunities, getting a shopping list together, given that, right now we're in a bit of market turmoil. Great tool. Love it. Great UI. Check it out.
Ladies and gentlemen, welcome to episode number 12 of Investing with the Boys. If you guys can tell with how the market's reacting this week, North Korea bombed U.S. No, it's been a crazy afternoon. I'm currently looking at QQQ down 4.5% after hours. Trump had his liberation day. The only thing liberated was our bank accounts. I don't know. It's been a crazy, crazy time right now. Logical, I want to pass it to you first to see how your reaction is from Liberation Day, and if you're happy with the president we have in power and what you're going to do about your future actions.
Yeah, I'll say absolutely not happy with this. This is this is the worst case scenario for sure. I mean, these are huge numbers that he's tossing around. At first I was hearing him, oh, we're just going to do a reciprocal tariff, 10%, something like that. And I was like, oh, markets are ripping. And then it's like, oh, wait, auto tariffs, 25%. On foreign cars, and then it was like, oh, and here's like this sheet of all of these different countries and the specific tariffs that we're applying to them. And I think like the China cumulative tariff is going to be about like 54%, which is just insane. So when you do the math, I don't see how this doesn't lead us into a recession. That's the TLDR. Prices are going to go up. So think about it like this, right? Costs of goods are going to go up. For these companies to keep their margins intact, they're going to have to raise their prices. And, at some point, how much can the, consumer afford to buy to make up for that lack of volume? And also, we're going to see potentially to keep your margins intact, you're going to have to probably do layoffs. So I would imagine that unemployment ticks up from here in many sectors. So it's just a very bad scenario. I mean, I was feeling really good into the announcement today. I was very long. I know I've been like snip snap, back and forth with my allocations. But yeah, exactly. I have gone. I just went from super long to like way less long. Like I cut like in after hours. My strategy probably won't work when I run, like, let's say a big fund where I have like tens of millions of dollars. I can't just be in and out of positions. But guess what? I'm a retail trader and I can be a lot more fluid. So what that means is, in after hours, when I see this information, I can immediately start reacting. And the way I look at it, I make really quick judgments and I'm like, this is bad. So I was definitely overexposed to the market. And I just went ahead and cut, my lowest conviction names, the ones that I felt are going to be the most impacted here. Anything with consumer exposure. This is kind of what I've been talking about for the last couple of months on the podcast is like, I think, we're already headed to a consumer slowdown. This is next level. I cut a lot of tech. I cut a lot of ad tech, which I was talking about that being a real risk. We already knew that with the uncertainty of tariffs, that we saw marketing budgets getting slashed. That's why names like Magnite were down 50%. I know the Trade Desk had a company-specific miss, but that's down 50%. Reddit is down more than 50%. So we know that there's a big impact to businesses. There's uncertainty. they're pulling back their marketing spend. They don't know what is going to be impacted with the end consumers, the end businesses that they work with. There's just going to be a pullback across the board. And when the market was looking for certainty, we thought that today could be potentially bullish because it's like, hey, maybe if it's not as bad as expected, we just priced in way too much downside. I think that this was the worst case scenario, and we didn't price in enough downside. And that's clearly why in after hours, dude, you're seeing Apple, household name, safest investment basically on equity markets, down 7.3%. They're extremely exposed. Nike down 7%. Q's down 3-4%. SPY down 3-4%. These are actually now below the lows of this recent correction in the after hours. If you look at the post market performance and the price levels, we are below Monday's lows. Which were new lows of the correction. So we thought we were gonna bounce. I thought so, but we just made new lower lows. IWM now in bear market territory. Yeah, there's just no positive spin here unless other countries capitulate. Trump capitulates. But let's be real. He has told you that he is focused on the bond market. He has told you he does not care about the stock market, and we thought he was bluffing, but clearly, he's willing to see more pain. They need interest rates down, and he didn't want to go with forcing getting into a fight with Jay Powell. So he went and he modified fiscal policy, and it's likely going to cause us an economic slowdown. Perhaps he thinks that this will truly be Liberation Day. I mean, this is going to be in the history books, you would think, if it doesn't get rolled back. This is going to change a lot of how trade is done in the world. Trump 2.0 is very different than Trump 1.0. And what's really crazy about this whole thing is, how there was a lot of uncertainty going into today. Nobody knew exactly, like Besant doesn't know exactly, we're going to have a max cap on tariffs, etc. But there was an interview afterwards where, they were talking to Besant and he was saying, they're asking him, so is the tariffs on China, is it like 54% cumulative? And he basically said, yeah, I think so. Something along those lines. Basically, like, he's not even sure, which makes you think that Trump, I think he held his cards close to his chest, and he wasn't really, I think this is kind of like, I don't know, it feels like a legacy play. Either he's going to bring other countries down to their knees and capitulate to us, or he's just going to set a new path that the U.S. is on for the next however many years and bring back manufacturing here. I think the problem with what he did was it was really aggressive, really quickly. And the problem is that we can't really get manufacturing up in time to replace our trade partners. So that is just going to sting, and I just don't see how this is going to work. But right now, I would say it's a very bad outlook for equities and the economy as a whole. Like, I don't want to sound super bearish. I was super bullish into today, but it's just hard to find the positive spin here. I've been talking for a lot, so I'll pass the mic.
Yeah, I was caught very off guard with it. I think we're all kind of watching the futures aftermarket and seeing the after hours market prices, watching the tariff announcement, Liberation Day announcement. And coming into it, I mean, I'm always going to think that the market's going to be up at the end of the day, right? Probably not tomorrow, but long-term wise, it's going to be somewhat like COVID, where we were down 30%, and then lo and behold, a year later, it didn't really seem like it was that big of a deal. Even like 5 years later, we are not even close to those COVID lows. And I'd imagine maybe 5 or 10 years from now, it's going to be the same scenario. But I've always been pretty cautious as far as where it's going to end up. Never really expected all-time highs anytime soon, but at the same time, I did not expect to have lower lows, especially after hours in the market. And I had three scenarios in my head. One, either the tariffs aren't going to be as bad as I'd imagined, and I think that's how the market reacted initially. Two, the tariffs are basically going to be exactly what he said, which I would consider as bullish, because that would mean that it was already priced in. Or three, worst case scenario, where that the tariffs are going to be worse than expected. And ironically, like you said, we got the worst. And so much so that even with the confusion as far as Trump is on his side, where he doesn't even, I don't think they have any idea what the absolute number for the tariffs are. But he just pushed so much uncertainty into the market that's where we are today. We don't know how this is going to be. This guy, I wouldn't say is a loose cannon, because I would think that there's some calculation in what he's doing, or what his cabinet's doing, because it's obviously not just him. But one thing caught me by surprise today. I mean, I've listened to quite a few amount of interviews with Scott Bessent. As a lot of you guys probably know, he used to work for George Soros, worked side by side with Stan Druckenmiller, ran a hedge fund for a few decades, and would think that, okay, he knows what he's doing and how it's going to impact the markets, right? He knows that hedge funds can blow up. He knows that there could be repercussions if hedge funds or large institutions blow up. This is kind of what happened during COVID, where there was constant blow up after blow up. When large firms blow up, they need to clear their books in order to put themselves in a much less risky scenario. Maybe not completely. I'm not a hedge fund manager, so I don't know exactly how that works. But I do know that when someone blows up, something bad follows, right? And I think that's a lot of what we're seeing right now, especially in the after hours. I think a lot of books have to get liquidated. A lot of people got tapped in the shoulder, whatever it is. I think that's what happened, and that's going to cause major volatility for now. I nibbled a little bit after hours on some high conviction names, but I'm certainly still cautious of some cash, so I'm not trying to dive into this. At the same time, I mean, the chance of a recession on Polymark went up 44%. Not went up 40%, but it's at 44% right now. The thing was like 20% lower just a couple weeks ago. That number is rising. The chances of a Fed cut coming, as far as CME Fed funds futures goes, for the next Fed meeting is about 8%, but that was before close, so let's see what happens. 10 years falling like a knife right now. The 10-year yield, which means that bonds are going up and yields are dropping. The market is sniffing out a recession. I can't tell you what's going to happen, but I'm going to tell you what the market thinks right now as far as the bond market goes, which is what Scott Bessent is mostly concerned about, the bond market. They want to reissue debt from the Treasury at much lower rates so they can reduce the payment on their loans or quote-unquote treasuries, so they can reduce the rate of increase of fiscal debt, right? And they're reducing spending to account for that as well, so they have to issue less treasuries. But when they refinance those treasuries, when they issue more debt in a debt ceiling that's coming up, because right now they're drawing down on the treasury account, TGA, they want to make sure the rates are lower, so that way they don't have to owe as much money in terms of those payments. And the way to do that is to potentially cause a recession or manufacture a recession. When you manufacture a recession, the market gets ahead of it by fleeing to safety, but also they get ahead of the Fed, possibly trying to cut rates, so they will bring that long end of the curve down. To which Scott Bessent has always said, I do not want to refinance, or I do not want to issue debt in the short end, I want to do it in the long end. And the long end is definitely coming down right now, 4.05% on the 10-year right now. Big move after hours.
I didn't know that. Well, I'm glad we have some TLT as a hedge, man. I mean, that's insane how quickly it got below 4. It's so funny. They asked him about the market after hours, and he was saying something like, it sounds like a Mag 7 problem, not a MAGA problem.
I quote.
He's sticking with his boy, so I got to respect him for that.
The market sell-off is a Mag 7 problem, not a MAGA problem. When I heard that, I was like, holy cow, that doesn't sound like Scott Bessent. And then it's confirmed. He said that. Yeah. Dude.
They
don't care.
Sam, I don't know how you were buying things in after hours. I couldn't sell things fast enough.
I nibbled.
Okay, because I just feel like tomorrow is a limit down day. I just don't see. I think everyone is going to. I mean, I don't want to talk too much about this because this episode comes out after the fact. But I can imagine that people are going to be headed for the exits. I don't see a bullish scenario for equities at this point. They just basically confirm, unless the story and the narrative changes, unless there are compromises, negotiations, etc. They asked Trump after the press conference, are you going to negotiate any of this? And he said no. So, I mean, it's crazy. I just don't see it right now for equities. So, for me, like I said, I cut anything that I was already concerned about. I was trying to call bottoms and stuff like that, but this takes us much lower. And protect yourself at all costs. So, I mean, that's how I'm looking at it. But anyways, you're saying? I
mean, just to respond to, we don't know why I nibbled, because I'm looking at certain companies from a micro perspective, and I can time the market. And if I'm thinking, especially with these companies, okay, because I got to be honest, I could trim a position That's not, again, just to reduce the beta of my portfolio, because my goal is to not have my portfolio swinging massive moves up and down every single day. So I can manage my risk by reducing the beta of my portfolio, by reducing the size of very high beta positions. But the positions that I do add to, usually in these downturns, unless it's something that I kind of want to grow from a much smaller position, I have no problem adding to Amazon. Being that it was like 182 after hours, so it was a pretty nasty drop. We'll see what happens with that one. Might go down lower. I'm not going to try to time the bottom, dude. But I told you, I have my hedge.
Is my 120 call going to come to fruition?
That 120 call is looking pretty good right now. But I had the TLT hedge for quite some time. So, if it's anything that's going to bring out some more cash when I do sell that, I do anticipate TLT going on a massive move since it's been consolidating for a month or two. So we will see what happens. Now, before I talk for a long time, before we talk for a long time, what is going on in Mr. Bueller's head?
You guys covered a great amount. I'm loving this, to be honest. I wanted lower lows. I want that pain. I'm a masochist. Come for me. No. I have a fat cash position, and I haven't been adding and digressing in quite some time. Like, even when we had those bounces, like, I was the Grinch among us. I was the Grinch among a lot of groups. Like, I just wasn't buying this bounce. I thought that this tariff relay itself was it wasn't going to create clarity in the near term. We won't see a V-shaped recovery. Like, there was some structural damage that was created from POTUS, and it wasn't just like the specific details of the tariffs. It was a lot of the second guessing that a lot of the enterprises C-suite had to do, which prolonged a lot of business spending, which had some hiring freezes. Same thing for the consumers. Like, consumers aren't that idiotic. They see the headlines of goods going up, and they have to prepare for the worst. So all the impacts had been made. So this April 2nd, Liberation Day, I did think we get some kind of near-term balance, because we would at least get somewhat of a box of risk control for the enterprise space and C-suite. Okay, we know what it's going to be like, so now we can be in this little sandbox and do some strategic initiatives. But nobody anticipated these ridiculous numbers, and not just. The reason it's so ridiculous is because what is the methodology behind these numbers? Like, are we really going to trust their word? Like, oh, this is what we're just doing half the tariffs, and this is what the numbers are. There's no methodology behind it. I was shocked to see how high some of these tariffs were to begin with. I was like, what? They're charging us that much? Like, I know their tariffs on us is significant, but I didn't think there were that many above 20 to 30%. Like, I had no idea. So I think it was completely unserious. I don't think they're using actual tariff data. I think they're using somewhat of a calculus to justify their numbers that have tariffs involved with it, but it's a little manipulated. It's a flawed formula. And it takes, I think Kevin Green said this actually on the spaces we were on today. Or maybe it wasn't him, but it was their formula right now. Correct me if I'm wrong, guys. It's taking the actual tariff data, it's taking a trade deficit with a country and dividing it by the country's exports to the U.S., and they're using that as their tariff data. It's something it's a brand new calculus. Let's just say that. And it's causing us to now potentially have 54% tariffs in China. We're going to have 49% tariffs on Cambodia, 26% on India, 36% on Thailand, 32% on Taiwan, 20% on the EU. These are... This is just so reckless, and if it's real policy and we're going to see more and more like this, I do think we're going to be staring down a barrel of a trade war that's going to touch nearly every single global supply chain. So this isn't me just having a tin hat theory on. It's not theoretical. These implications are massive. I don't want you guys to see this episode and think that I'm laughing and joking. This formula, this calculus are created, it's a joke, it's ridiculous. The implications are massive, and unfortunately the rich are not going to get impacted. It's going to be the poor. It's going to be those individuals, those demos who rely on the brief bottom line margins they have to be able to buy the knockoff goods that's made in China, the knockoff goods that are made in Taiwan, Thailand, to provide these like they're just breaking even, just getting their neck to the water.
Sorry, can I just cut in on that thought before I forget?
Yeah.
It's going to affect everybody, and I'll tell you why. Because I forgot the exact stat, but I think it's like the top 10% of Americans do 50% of the spending. And I think that the way it's going to impact the rich is through the stock market and assets.
Oh, yeah.
And so I think that we're going to have a reverse wealth effect. I think for the last few years, we've basically just seen asset prices inflate.
Yep.
And so if we do have that recession, right? So like, let's say the lower income person is going to potentially, there's going to be people who get laid off. Obviously, that's the worst bunch. Like, that's going to be horrible. But there's going to be people who can't afford to buy things when goods are higher prices. For sure, they're going to they're going to spend less. That's for sure. But if you don't lose your job, I mean, I think you're going to be okay. I mean, considering like the impact you're going to have is like, maybe you buy less stuff with the same amount of money, but you don't have the assets that are going to deflate. So if you don't have assets, and again, if we go through like a real recession, we have not priced in a recession in this market. And, you know, asset prices can go like 30% lower for sure. Sorry, were you going to say something?
No, I was going to say, you're right. Like, I will say the rich have a stupid amount of cash, and they also have a stupid amount of inflow that even if the market does, I don't know, go through that massive compression, bear market. Exactly. But a lot of other demos, they don't have that luxury. I'm telling you, I know you guys agree with that. I'm not saying you disagree, but like, I have the luxury of having a 4% cash infusion every single month. A lot of my subscribers, a lot of the people I talk to, it's fixed what they have in their portfolio, and they were maxed out in December of last year. So now they're 30% haircut they're getting on their portfolio. They can't buy the dip. They're just holding the bag on that. And I think Vishal was saying this earlier, and it's so accurate on the psychology about it, is people think that even though it dips 30%, it can't dip anymore. That's just so false. It can dip 50, 60%. Like, there is okay to stomach a 25% dip, raise a 15 to 20% cash position in your portfolio. So if things get capitulatory, if these get prolonged, it's not just a 6-week pullback, it's a 6-month pullback. You will have some dry powder to capitalize, because there's worse.
Sorry, what did I say last time? I said this exact point was like, people will buy the dip on something that's down 50%, but if the total drawdown is going to be 70%, that means that when you buy the dip at 50% down, it has another 40% to go.
Totally.
Yeah. So it's just a tough. The math is tough, man.
And QQQ, I'm underwriting QQQ breaking 400. I think there's gonna be a lot more pain. And
yeah,
I think
it's going to 480 or something. Probably. If nothing changes, it is.
Because it's a structural issue, not just technical. Technically, holy moly, you have to be an elementary TA just to see how terrible it is. I'm elementary. Like, maybe I'm above average. I'm probably 8th grade level of TA. It's ugly, and it's going to take weeks, probably months, to actually recover. So that's just a technical level. The fundamental.
I mean, real quick on the technicals though, you're looking at after hours action. So Monday we made a lower low of the correction. So that was actually the lowest point this Monday, 546 on SPY.
Lower high, you're saying, right?
No, lower low.
No,
on
I'm
Monday
saying
morning
that
when
we made a lower high today.
Sure, yeah, but I'm talking about we made the lowest point on this Monday, just this Monday.
Yeah.
So we were still definitely in this downtrend. So I'm talking about it from a technical basis. Like, I was looking at TradingView in after hours today, and the low was like 546 or something, and SPY hit 545. So in after hours, we made a new low. We retraced all of the 3 up days in a row, and we made a new low. And that's in after hours. That's when there's not a lot of liquidity and volume. If this is the sentiment in after hours, what do you think is going to happen tomorrow? Like, it's going to be capitulatory. Like, I said that word wrong. Capitulatory. Yeah, that's the word.
No, I mean,
yeah,
no, you're right, because like, I think that first off, this is part 1. Part 2 is, what the hell is the rest of the world going to do in response? Are they going to go the Israel route and just like, all right, we'll take our tariffs off, and like, it's a race to zero, and like Trump, the bluff worked? Or are they going to do brute force with brute force?
If we go to zero, like if this works, what he's doing, then I'm back to bullish 100%. But if like we're this is crazy because the snip snap scenario, but it's like, dude, it's tough to get constructive if these are the rules now. So if the
It
rules
won't be that
change-
quick, though. It won't be that quick
won't be that-
because
we're gonna see-
geopolitically, things don't happen in weeks. Look at the war we're having in Eastern Europe. It's like year
Okay.
3 or year 4. It takes a while. But yeah, Sam, what do you have to say?
So here's the thing, okay? And this is coming from like a complete, I'm a long-term bull scenario, okay? Because I think out of all of us, I was probably the most bullish one last week. And I have to say that the only thing that's like making me move forward in this whole scenario, from keeping me from liquidating my whole portfolio, is because I know one day, I don't know when it is, the market's going to be higher. And that's going to be well before my retirement age, which I'm cool with. And that's the only reason why I'm doing this, right? Because we're all investing with money that we don't, well, hopefully we are. But I'm pretty sure we are, us three are, but hopefully everyone else is investing with money that they can lose. They could stand to lose. Because when you're in the stock market, it is one of the riskiest places to put your money in. And see, this is the thing with people like pumping calls and everything, like every single day, doing all this stuff. It's because you're, especially this year, you're like one tweet away from losing all your money, right? Especially if you're playing like short-term calls. And if you don't manage that risk, you're going to look at today and be like, oh man, I'm going to be smoked tomorrow. So here's the bright side, right? And this is the reason why I was pretty much taking some off the table in the beginning of the year. I already told you guys, but also on top of that, not being aggressive as I was in 2023 and 2024 was because we had phenomenal years in the last 2 years. Why would we go so hard again to press it? It's like going to a casino and going all in, winning, and then going all in again and winning, which is a 25% scenario in a coin flip, and then trying again. That's a 13% chance getting heads up if you're doing heads 3 times in a row. Obviously, the casino odds, you're losing, right? The casino has rigged every single game so that way you're losing. The stock market is built for you to lose. If it was built for you to win, there would be no such thing as losers in the stock market. But it is built for you to lose because there's a buyer and a seller in every scenario, in every trade, no matter what. If you come into this year thinking we're going to get another 25% up year, you're really pressing it at that point. You're hoping that we're going to hit that 12 to 13% chance we're going to have a big year. Because in actuality, no one knows what the stock market's going to do. So I would say that if your tongue is in the back of your throat tonight, you might be over leveraged, or you might be playing with money that you cannot afford to lose. And in these scenarios, it's a big wake up call. When we were down 10%, that should have been a big wake up call for everyone. And I'm not going to say like, hey, you should have, because I made these mistakes all the time. Okay. I made it in the past so many times, and I'm not saying I'm not going to make a mistake again, but I will make these mistakes again. I promise you I will continue to make mistakes, but man,
Sam,
you better believe
I mean,
how risky this market is.
Can I just say, like, I think it got a little bit too easy, right? Like, people were definitely like making money way too easily, and
Exactly. Yeah.
I mean, things were up like so much, right? So I mean,
It was the market
think
was
you-
green
yeah.
every day.
That's why I'm so happy, because there's some freaking egos or heads getting big. I'm like, y'all are these
Yeah.
guys who thought they were like the shit. You guys are one trick ponies, and you're acting like you're the next Buffett. So I think we need that.
We need
like,
this.
we use the term detox because Trump used that for the economy. There need to be a detox across the board, and we're getting one. And the thing with the detoxes is they take a while to phase out. If you guys, that's why I was never like that bullish, is because the detox we're experiencing, it's not going to be in weeks. It's going to be in months. And I'm now underwriting. I don't know if we're going to finish green this year. I don't. I think this psychological effect that's happening on across the board for consumers and enterprises, it's going to be prolonged. Even if, I don't know, next month all the tariffs go away, that damage for the past couple months is going to be impactful for at least another quarter or two. So I think I was writing this to my subs earlier this afternoon, because like I'm just trying to figure out a way to phrase it to them where I am. It's tricky because like I have, again, cash coming in every single week, and like I could be even though I have a fat cash position, I'm still doing little snippets. I didn't add anything after hours today because I think it's going to be, like Logical said, limit down day tomorrow.
Dude,
If
we
not,
just made a lower low. We made the lowest low of this pullback, this correction in after hours, and that's before all of the big
Totally.
money managers who know more than us, who are modeling every scenario, who don't want to be left holding the bag. There's only one exit, right?
And-
everyone is headed for the same exit.
So-
It's the bid.
And I think it's
Everyone's
really
hitting the
important.
bid.
And I think it's really also important to ignore your instinct to hedge now, if that makes sense. I think the easy money was. I'm not saying short. You guys are great.
I don't know.
I think you guys are. No, you guys are. Let me finish my thought because I think
Okay.
you guys are like way above average. You guys know how to portfolio manage,
Fair.
but I know a lot of people like see that blood and they want to hedge. The hedging is you can't buy puts right now. You guys are showing shares. Buying puts right now with the IV being spiked in contracts, the risk and reward just is not there.
Yeah, well
the,
said.
The
100%
contracts
agree
are
with that.
the contracts are pricing in the reality of the fear. That's not when you buy puts. So don't ignore the urgency to buy those hedges via puts. Shorting a stock, I think if you're experienced in doing so, I think there's some great opportunities. I think retail's screwed. I think retail stocks are really screwed right now.
Yep.
But also, are you going to be able to be in front of the computer like Sam and Logical all the time and monitoring like the news flow, being in tune to the market and seeing the price action?
I'm not in front of the computer that much, and that's
But
the
you're-
reason why
you're
I
in tu-
don't. I'm in tune with the market because I kind of have an idea, but more on like
Sam,
a
you,
longer
the
term scale.
point is that
but
you trade at an above average capacity
so
often.
so I don't.
Most people
think-
spend an hour a day. That's the thing. You don't. That's why it's like it's tricky to short something when you're not in tuned with the market.
So I think that to say it's too late to buy hedges, I don't think because people buy hedges for multiple reasons, and there's different ways to hedges, right?
Well,
'Cause
just raise cash. I'm
TLT.
just saying that's at least
Okay,
raise
well,
cash
are
though
you-
at this stage.
Well, you could raise cash, but there's different ways to hedge, right? You can buy TLT, or you can go long bonds, right? Which is what I've been doing for quite some time. But that's a hedge because considering a recession does come, and like I was saying earlier, the market's going to front run the Fed. They're going to drop the rates. So that's actually been happening for the last few days. Also, there's another way to hedge by going into XUS, or you can hedge by going to staples or utility companies, or you can hedge by going FX on whatever. There's different ways to hedge.
I do think if we limit down though, everything goes red. That's the issue. Like
Yeah,
I think
it's-
everything's gonna go red.
Right now, tariffs are with other countries.
Yeah.
AWeb is down 6-7% after hours.
No, I was just giving different options of hedging.
No, I
because
get-
I think
I get
in
it.
terms of hedging, what Shai you're trying to say is hedging, as in like buying puts, which is what you said before, but also like selling
You
your
can diversify.
positions, or but diversification or cash position is a way to hedge. And I don't think there's anything wrong with like trimming a position even after the market's been down, because guess what's going to happen if the market's down even further a couple months from now? You're going to be happy you did that. If you're trying to reduce the beta of your portfolio. When I say beta, I mean like the volatility of your portfolio. So the number at the top, right? Then reducing that beta by trimming some positions is totally fine, or even adding exposure that's lower beta. Like if you wanted to add like staples companies, that's a beta lower than 1 for a lot of those companies, right? So you're reducing the volatility of your portfolio. There's different ways to hedge, and I don't think there's ever a wrong time to do it. It really depends on the person who's doing it, right?
Well,
so go ahead.
No, you brought up a good point. At the end of the day, like we're each gonna have our own color on hedging.
Exactly.
You have to ask yourself, like, what are you able to sleep at nighttime comfortably? If you can't, you need to adjust something
That's the point.
And you can
yeah.
even just sell
Yeah.
your holdings and go to more cash. And like in this
That's what I'm saying.
volatile environment,
There's different
have
ways
like
to do it.
50% cash, trade in half size or whatever that is. Yeah, real quick. Oh, and also Sam, I agree with you. Like I think TLT has been a good hedge, like you said. I mean, the 10 years about to crack down below 4. That's insane. That is like limit down basically for
It's
the
a flight
yield.
to
But
safety. Or gold.
is
I
a
forgot to
flight to
mention gold
safety.
too.
Yeah, so gold's been on a tear all year, but here's the thing too. One thing to consider, and I'm not in this camp, but people would argue, and again, I switch now to owning a lot of TLT as a hedge as well. But I think second order effect is like potential recession, and that's what's getting priced in now. I think first order effect though is that price goes up for a lot of items, and so CPI potentially can go up on specific goods. So that keeps the Fed from cutting rates because there's going to be this inflated inflation, etc. But again, I think that markets are probably looking through that to the second order effect, which is going to be a slowing economy. I did want to follow up on what you were saying, I just saw a Twitter post come up. This guy cracked the tariff formula. It's simply the nation's trade deficit with us divided by the nation's export to us.
Oh, like, so I was right.
That's ridiculous. Yeah,
I was right.
So I mean, okay, does he walk back those numbers now? Like, do we start?
No. That's what I'm saying. He could care less on how he got there. He wanted to make an impact. It was such an. I made a post just right now as we were doing the spaces because I was like got inspired by it. I was like, I said Trump's tariff plan was messy and poorly executed, but it had real impact. That real impact is all he cared about. And he was like, he told his quant guys, I don't care how you guys get me these numbers. Just get it there. I'm going to say it on Liberation Day, and I'm going to detox this world. And I'm going to cause the first global recession man-made since World War II, and I don't care what anyone says.
Dude, Shah, you know what's crazy about this thing? I know we've been going back and forth with these tariff headlines, and we're like, our heads are aching at this point. But dude, even just as recently as yesterday, he said, "Oh, we're gonna do the tariffs. We're gonna be really kind. We're gonna be lenient. These tariffs are gonna be lenient." And then he goes on stage and says the biggest number possible.
He is being lenient though. What are you talking about? He's doing a 50% discount.
Yeah, they're doing that.
That's super lenient.
This guy's gonna crash the world. Oh my goodness. Like I said. Sorry, go on, Sam. Go ahead.
I just have to say though, and this is just the contrarian inside. But actually, by the way. Yesterday's April Fool's Day, and probably one of the funniest comments that I saw on Twitter for April Fool's Day was that Peter Schiff said I was wrong about Bitcoin. I laughed my butt off when I read that. It's like, this guy's notorious for being the most Bitcoin bear you could possibly think of, gold bull, whatever. Anyways, that's a thing that I see on like Twitter lately. It's like there's not a single bull in sight. The sentiment is so bad. Like you guys have to.
Sam, I think you're wrong, man.
So bad right now.
Sam, you're very I think you have like a very specific group of people that you're viewing, but like I'm getting dunked on in my comments because I said I adjust my portfolio, and they're like, "Oh, I'm buying," and I was like, "Knock yourself out."
I do think people were positioning for a near-term bounce. Yes.
I'm talking about right now. I'm talking about right now. After hours.
I'm talking about right now.
Really?
Minutes before I started. Dude, I think I sent it to you guys in our message, but like, dude, it's like, look, I was also super long today. Like, literally, I went from 125% long into the close, and I see the markets ripping on the first thing, and then we tank, and then I understand the implications of what he just said, and I'm like, oh, this is really bad. And I went from 125% long to like 40% net long in like 30 minutes. I placed 100 trades. I'm not kidding. Straight for the exits. And like, I will wait for clarity. People will say, what are you doing? That's over trading, blah, blah, blah. You're right. But, Sam, earlier you're making comments of like, we're investing with money we can lose. No, man, I don't want to lose my money. And I went through a really brutal 2022 and
no, man, I don't want to lose my money, Sam.
I'm saying, you're taking what I'm saying to heart as in like, I don't care about this, Michael. I'm just saying like, I guess it really depends on the individual. Maybe you're right. For me though, like, obviously I don't want to lose my money, but if I was playing with money that I need to eat the next day with, I'm going to be an edge every day, right?
Let's just say this.
You're doing enough to sleep at night, like what Shai was saying. If you can't sleep at night, then there's a problem in your portfolio of the way
I'm just hyper paranoid right now, and I'm trading with my entire portfolio. That's how I'm treating it. And so like, I'm more trading in this environment specifically. Like, it's easier to be long in a 2024 low vol 5% pullback kind of situation. I did not trade like this, but when we're in this volatile, regime, basically, I'm trying to make sure I'm hyper paranoid to downside. Because this could get worse, and guess what? If it doesn't get worse, okay, I'll take it on the chin on some of my shorts. I'll close them out. I will, my longs will go up. I'll buy more longs, and I'll go back. I'll trade it around.
Well, here's the one thing that people aren't talking about really, and I think it's earnings season is right around the corner.
True.
I would not be surprised if guidances get taken down completely.
Destroyed.
Yep.
Oh my.
No. They remove guidance completely.
Oh, that's worse.
I think that I've been part of those conversations in the boardrooms. Would be my advice when there's so many unpredictable variables.
That's way worse
that
than
you just
lowering guidance.
Oh, we're going.
No.
We're going to a bear market if that.
no, but I'm telling you,
way
it's going to be a
worse.
trend. It's going to be a trend though that's going to be digestible. That if a couple companies do it, the rest will follow suit and be the status quo. Then it'll be okay. But how can you produce guidance right now when you don't even know what the behavior is going to be post these massive tariffs? You just can't. Even the B2B businesses, you can't, because the demand is going. IT budgets aren't freezing, but they're getting pushed back a bit on their aggression, like towards the second half of this year.
They've been getting pushed back for a while. IT
Exactly,
budgets have
because-
been. You've heard in earnings calls from Q4, especially all the cybersecurity, even Palo Alto, and not a Palo Alto. Well, I hate to say it, 701, but a lot of companies, even in cybersecurity, one of the most stickiest budgets you could possibly think of, because a lot of companies don't restrict cybersecurity budgets. It's like, yeah, let's just leave the door open a little bit more and we'll be good. Like, even those contracts, people are opting for something a little bit cheaper, reducing the budget. When that happens, that means that people are definitely uncertain. When the CEOs and CIOs are uncertain, that's when you're going to start seeing the markets. I feel like we were pricing that in for quite some time, but this is a bomb that was just dropped in the market after hours. Like, numbers will be changed as far as guiding sales and whatever it is.
I think also what a lot of people need to realize is the best opportunities when there's like this kind of catalytic events don't usually show up right after the panic. They show up once the panic intersects with the data, aka their earnings and fundamentals. And then the market realizes it, overcorrected on fear, and then we bottom out. We're nowhere close to that. Like I'm underwriting Q1 was the reset. The narrative got communicated to everyone that we're detoxing and things will get bad. Q2 is where the numbers are going to start to reflect it. Q3 of this year, I'm hoping, is when the real setups emerge once some of the policy dust settles in and it becomes clear which companies are actually positioned to still do well this cycle and which ones are, whoa, those anchors are going to be there for a while. And hopefully by Q3, the tariff war isn't as, it's taken down by 50% essentially. And that's going to be okay. But if we have this issue past Q3, we're going to be in a big recession. Like, I'm not just like fudding everyone out right now. Like, if this lasts past Q3, we're going to be in a single man-made recession that's going to affect the whole world. That's going to create a couple year dead period. And I just don't think, you guys might say, like, I think Trump has an ego, and I don't think he wants to be the first person since World War II to create a world recession. I just don't see that in him.
So
Shai, I want to just caveat that one thing, and I'll pass to you, Sam. Is like, I know, but at the same time, dude, we've been snip, snap, snip, snap. So I do want to give like listeners kind of maybe a glimmer of hope that, dude,
oh yeah,
I think I've been seeing a very good phrase being tossed around on Twitter, and it is strong opinions loosely held. Right now we have a strong opinion, and it's loosely held, because if the situation changes, if the narrative changes, we will change with it. I think that's really important, but right now the narrative is really bad. Sam, go ahead.
Yeah, no, I mean, I was going to say that, I forgot what I was going to say.
I think you're starting off with Shai. You are so right. I respect everything that you're saying.
Yeah.
And then
No, that wasn't it.
I interrupted
That wasn't
you.
it. No, go ahead. I completely forgot what I was going to say. Go ahead.
No, I mean, I can go. You're right. Logical. Like, that's a great phrase to remember. I just think today was somewhat more permanent than the past couple. Like,
I don't think they were on the
months.
same page about anything, and it feels like Trump, dude. You listened to that speech? We were on Spaces together, listening to it live. He was like, "This is going to go down like in history. Like, we aren't going to like." It was
Those are words you don't want to hear.
And
Dude,
and
was
he's making his like panel mates look like idiots because they're out of the loop. So like that just shows to me like the really smart people around him, they're in the dark. Well,
Yes.
that's scary. That scares
Loose
the
cannon.
living
Well,
shit out of me.
I have to say that so you're underwriting, Q3 is probably going to be the times when the deals come out. But that's an assumption that things are starting, or at least they will start to get figured out at some point. But like you're saying, is that, well, I mean, this guy's a loose cannon, right? We don't know what he's going to say, and we got 4 more years of this. But something to keep in mind is that those midterm elections, right, even though they're coming up in a couple of years, there's a certain point where he needs to start getting his ratings.
It's not a couple
up.
of years. It's next year.
Okay, there you go. So there is a point where the ratings have to come back. The approval ratings have to come back. For him and his entire cabinet and whoever else is running in Republican court, they got to get those ratings up. So I kind of agree with you that maybe around the third quarter, but maybe I'm speculating a little bit, but it might be a little bit sooner than that, mostly because the market tends to front run the actual announcement of the recovery before it actually happens. Sure. Like, I thought that today was going to be somewhat of recovery because I didn't think there was going to be any type of uncertainty priced to the market. And we saw today that there's even more uncertainty. I don't really think it matters like what the tariff was, but the fact that everyone's like, hold on a second, how do we calculate this thing? We don't, and we're just thinking about it, right? So these big institutions are running these numbers and they're just like, what do we do over here? We don't know what to do. So that's even more uncertainty. So it's like, the market will rally uncertainty and it'll fall on uncertainty. And I mean, they just introduced a hell of a lot of uncertainty today. It's so hard to even know when it's going to happen, when the good time is going to come.
No, they go into effect very soon. They go into effect like April 9 or something. You said,
yeah, but how much? We don't know what the numbers are.
Well, yeah, I thought it's the numbers that he put out there.
No, I'm saying like those are probably going to change.
We don't know that. He says he's not going to negotiate, which means that
we'll see.
Unless they drop their tariffs, that's the negotiation. There is no negotiation.
Yeah, we don't know that.
Regardless,
that's different, right?
Regardless, so like 6 weeks ago, this is when we got the tariffs. Like, oh shit, tariffs going to happen. Mm-hmm. The earnings that are going to be reported this upcoming quarter, it's going to have half of the previous quarter essentially is going to be impacted by post-tariff FUD.
What was I saying? I was saying about Magnite, for example, and I'm like, dude, they had a great report and it's down 50%. I know I hate to keep using that example, but it's like the perfect example of you beat and then you're down 50%.
No.
There's something else going on there. Yeah. And it's, people are tracking marketing ad budgets and ad spend and they're linking it back. And it's like businesses are cutting back their marketing spend because they don't know the certainty around tariffs. And guess what? It just got way worse. So that's not improving. And yeah, I mean, I agree with you. I think next shoe to drop is probably earnings season. No guides. It's going to be ugly.
Yeah, well, I will say, guys, I won't be the Grinch. Half glass full. Maybe this is a negotiation tactic. Everyone in the market was underwriting 15 to 20% tariffs. He doubled it. Maybe he's like, all right, I'll settle with you guys in the middle and we'll get 15 to 20%. Like the EU, for example, is 20%. If they come back and not negotiate, but like they get it down to 10%, maybe that's the first sign of the other nations to also, like, I don't know, China would be at 20%. Japan would be at 12%. These are more digestible. Maybe that's like the next phase of this, but that's not going to happen next week. It's not going to happen in 2 weeks. This is going to be it's going to be a prolonged process, and this is probably going to overhang the upcoming earnings season. Really, you're going to hear it constantly. It's going to be the most annoying thing during earnings season. It's going to be the common boogeyman theme that everyone's going to use that as an scapegoat. It's just, that's how it's going to be. It's just like COVID.
Do you remember 2022, all the retailers, they were using shrinking and it meant like they were getting looted or something?
Oh my God. Yeah. It's the same thing with optimization. Like optimization was all in software. It was just like the most annoying thing. And like that's going to be it's going to be the same status quo, corporate 101 BS.
Yeah, software is going to get hit. It always get hits there.
So the bookings is going to be very bad.
They're so forward looking with all the metrics that any type of hiccup is going to be like 20% down. But if you miss anything,
can we talk about the fight to safety though in software? It's cybersecurity. It's going to be cybersecurity.
Yeah.
So like if you had to pick one, no, exactly. That's what I'm saying. If you had to pick like you want that growth itch still, and you want to capitalize on agentic AI, fourth industrial revolution, I do give my green light that cybersecurity is the top like sub industry to DCA into. I think the consumption model, software companies, they're in trouble for the next quarter or so. Like I think Snowflake might be in trouble. I think MongoDB, I could see MongoDB just getting really
they're already in trouble.
Yeah, I can see them getting really beat up. Like I think a lot of the experimental AI projects aren't going to be crossing the finish line to actual fundamentals anymore for the next like couple months. It's going to be pushed back 1 or 2 quarters.
Never in this scenario, if you're buying something, buy the leaders. Don't. Sometimes the value out there is value for a reason whenever it comes to software. Just being very cautious with MongoDB, especially Snowflake. You know, I have high conviction for long-term in Snowflake, but it's very tough to add to Snowflake over here in size, if anything. But there's a reason why CrowdStrike has not made a lower low, even though the market has made a lower low since the most recent earnings around 300. I don't know where it is after hours, but I think it was like around 350 or something when I looked earlier.
Same with Rubrik. Rubrik is like showing the most relative strength this year.
Well, I mean, as far as after hours go, it's pretty low float, so we don't know what's going to happen. But yeah, Rubrik it's literally one of like the 2 leaders in its sector in terms of data security. So yeah, I mean, those are the ones that I'm looking at for cybersecurity. I really want to add back Palo Alto. Very interesting one.
Let's go back to Rubrik. Who do you think is a competitor? 'Cause I don't see a real competitor with Rubrik.
There's that NVIDIA-backed company.
Oh, in the private markets you're talking.
Yeah, no, it's not a publicly traded company.
Okay.
Yeah, no, if you're talking about publicly traded, you know, there would be Commvault, there would be Acronis and all that stuff. I don't think Acronis is the ticker, but anyways, that's the Veeam as well, but that I don't think that's public either. But when it comes to most modern cybersecurity for data security, it is Rubrik hands down, and just the fundamentals of that company is just phenomenal. Especially since they had the Microsoft backing and all the people on the board. Also, most of the executive management in that company from Oracle. You guys have seen it as well, probably you Logical as well, as that. Anytime you got management that's from Oracle, that company's software is like, I wouldn't say top notch, but it's pretty up there. Same thing with Workday, same thing with a lot of other companies, right? So, you know, you got these companies where they're pretty much the leaders in their realm when it comes to software. Anything outside of that, it's very difficult to bet on that. But I mean, I would just say have the shopping list, man. I mean, if that's my walking away thing, is like just make sure you brush up that shopping list, blow the dust off if you have to, but like make sure you know these companies inside and out, that when you buy it, because at some point you're probably going to buy the dip. When you do, just make sure that you're going to be okay holding it if it takes a 50% haircut. I mean, it can happen. Like you're just saying, Amazon 110 a couple weeks ago. Now look over here. Yeah. 120. Mm-hmm. All right. My bad. $10 off. Well, I guess that's like $200 billion, but yeah.
It's people don't get it. It's like, it's a matter of like, how bad does it get, right? And if we do go into I was about to say depression, but recession, I only said depression because, dude, the last time we had tariffs this big, again, if they go into effect, right? That's what we're talking about. If they go into effect, nothing changes. I mean, I think the last time something like this happened was basically in the 1930s when we had a depression. So it's pretty crazy. And again, we're talking about like, okay, Amazon's goods that are coming here now have high, potential tariffs, whatever. They're making less margin on their retail business. Their people are losing their jobs. There's less people spending in the economy. You know what I'm saying? There's not wages going up with this inflation. There's less sales going on. Businesses are spending less on advertising. There's other businesses that are spending less on compute. It's just like a shitstorm. Sorry.
I will add. There is a whoa moment. There needs to be levers that has to be pulled as an enterprise when your cost of goods go up. You really can't do much with what you have right now. Are you now willing or forced in the corner to accelerate the adoption for AI to do the things that your FTE have been doing, but at a more official clip, that you can't really afford to keep your headcount right now because your cost of goods are going up? The number one lever that gets pulled is FTE reduction. Always number one. So you can't afford to remove the workloads associated with these headcounts. So you reduce to 10 to 15% headcount reduction. You still have those workloads and you don't overly exhaust your rest of your headcounts. What are you going to do? All right, we're going to spend this much money that we save from these layoffs, be much more aggressive on AI because that's inevitable. Nobody knows, like that's the future and we're heading towards there. Let's just go really hard at that investment year right now. And yeah, we'll see that. But again, we talked enough about tech and we talked enough about macro and how we're all screwed and like we should all go find a hole to dig into and wait this all out. Biotech had a capitulatory event just, was it yesterday, 2 days ago? It was like down 6% XBI. Like
Yeah.
you're the biotech, you're our chief biotech officer,
Go for
Logical. I want to hear your intake on that.
Yeah,
And
so
Korean barbecue.
Friday after market closed, right? And I've been like pounding the table on biotech. Friday after the market closed, so you couldn't place any trades. We basically got news that Peter Marks, FDA commissioner, was ousted. He cited RFK in his resignation. Clearly, they had some beef over vaccines, but it was a big blow for clinical stage biotech because he was a champion for approving many rare disease clinical stage companies, getting them to approval and commercialization. So Monday morning, XBI down 6%. I believe there's an index called BBC, which is the clinical stage biotechs, and it was down even more. So in 2 days' time, XBI was down 10%. So I saw that big move on Monday, and I'm like, oh, this has to be capitulation. And then the next day it was down another 4%, and I'm like, oh my goodness, this is crazy. And basically, this index hasn't made progress in the last like 10 years. I think the market for biotechs have been cursed since February 21. You had a lot of garbage in the indices that went public, like preclinical companies. And then sometime in 2023 or 2024, they basically rebalanced and reconstructed the XBI index. And so people are like, oh, I'm going to wait for it to get to $60, just like where it bottomed in October 2023. But back then, it was a completely different index. Now they've actually taken out a lot of the garbage. So XBI being at 80 is like XBI, old XBI being down at 60, if not below that. And a better method to understand how bad it is in biotechs, specifically clinical stage, which is a really important part of it, is if you look up that BBC ETF, it is down like, it is at an all-time low this week. So clearly capitulative, and people are like, oh, I'm going to wait for the lows on XBI, but they don't understand that in this sector, these things are actually decimated. They just don't know that XBI has been reconstructed. So anyways, big capitulation. I was buying that dip with both hands because it doesn't make sense to me. I think you had a lot of forced liquidation. And again, if the risks to this economy are going to be a slower economy, potentially lower rates because of that, that should be a tailwind for biotechs. And you're not really having an issue with consumer spend because their trials are going to go on. They're going to have FDA approvals, etc. Obviously, a bit of uncertainty right now at the FDA with all these transitions. But they named the interim guy who's basically replacing Peter Marks, and his resume is solid. So he still has a very similar background. I think you're seeing people who are really scared, and honestly, XBI was up 3-point-something% today when the rest of the indices were basically flat at the end of the day. So it was nice to see that kind of big bounce. What I don't understand is why is XBI down just as much as all these other indices when the risk really isn't there for them. So I don't know. I might have to load up more biotechs, but what I can say for the long portion of my portfolio, I have definitely transitioned to mostly biotechs. So the short stuff, I'm obviously looking at tech and consumer stuff, but on the long side, I'm mostly biotech because I do think these are basement valuations. They're not as vulnerable to a slowing consumer and economy. The lower 10 years should be a good tailwind for this sector. And then lastly, slightly different point is Latin America actually had the lowest amount of tariffs. So they were kind of the tariff winner because they lost the least, I guess. And so Latin America is another, I don't know, maybe 10% allocation for me. But I've been talking about, Bank of Colombia. They have a right-wing potential takeover in the elections next year, same as Javier Milei. And then you have Brazil, potentially at a turnaround over there. So there's some interesting ideas over there. But yeah, I think Latin America looks pretty good, and I may look to increase exposure there as well. But yeah, I didn't understand the biotech sell-off today, and so I'm going to look for places where I think can do well even in this scenario, and that's really all I care to be long, and kind of avoiding everything else for now until the dust settles. But anyways, I'll wrap that up there. A lot of interesting opportunities in biotech if you're interested. I do think that was a capitulative event, and so start doing some research and find what you like and that kind of thing. So
Yeah, create a shopping list. I mean, it's always what you want. Every single time we have the pullbacks, make sure you have your shopping list so you're not the baby always gets thrown out the bathwater.
Wait,
whenever you
can I just give one example, because our listeners probably know this one because this is a very popular ticker with retail crowd. is Viking Therapeutics. I know, Shai, you even covered it for a bit, but VKTX, I mean, dude, that thing went from like $20 to $100 at the peak.
Wow.
After they released amazing data around their obesity drug. And dude, it's back down to $23. Basically, it gave up its entire pump from the data. So it's almost like the company didn't even have the data to begin with at that point. Like, it's back at those levels. So, there are opportunities in this market. Once you've let this dust settle, there's, time to go dumpster diving is what I would say. But yeah, price you pay matters.
This is why I have speculative companies at very small positions because of what happens. Like, we were talking about ASTS the other week, and look where it's at now. It's like 40% lower, right?
Yeah, I exited it.
It's like speculative positions is probably not the best thing to go if you don't have the risk appetite during falling markets like this, because they could be the last to recover or not even recover at all if things get very bad. So,
but Sam, can I just say one thing? These biotechs are trading at like negative enterprise values. They're basically trading like nets. What that means is that they have more cash on the balance sheet than the market caps. So like you're paying, let's say this company's $300 million. Dude, they might have $400 million of cash on the balance sheet. Yes, they're going to burn some of it, but a lot of these are close to a point where they might get approval, etc. And yeah, and then obviously there's the commercial stage, which is definitely not as speculative. We talked about Arcutis on here. We talked about ClearPoint Neuro. These are companies that are real businesses with real products on the market, and they're growing. And no one's going to like stop spending money on, their eczema cream or whatever, even in an economic slowdown. So I do have a big allocation, mostly to commercial stage, but I've been dumpster diving into.
I mean, speculative is also eye of the beholder, right? So if that's not how you see it, then that's the way it is, and that's what you're going to add to. I'm sure there's a lot of ASTS bulls out there that are very happy for these prices and buying it because they don't see it as speculative, and that's good. Just put your money where you are convicted in. All right, 100%. All yours, Shai.
No, I mean, everyone and their mother was hoping for a big discount just 3 months ago. This happens every single time there's a correction. They all want one until it happens, and they get scared out. So if you're a long-term investor, this is a blessing. I don't have the urgency to like buy, but I'll slowly DCA. I have my list, like Sam said. Have that list. Be prepared. Put those limits in. Go drive Uber to get that extra cash. Do whatever you need to. I think we're still in the fourth industrial revolution. I think that's not going away anytime soon. The can just got kicked a bit. That's it. It's going through. We're going to come out of this stronger. I really do think we're going to come out of this stronger. Nobody knows how long that's going to be. But either way, don't get greedy. Don't feel like you need the urgency to buy this dip because we're down 4% after hours in QQQ. More pain can come. And be prepared. And I know this is like, I feel like 4 or 5 straight episodes we've been talking about the market being red.
Because it is red.
Correction. It is red. There's nothing we can do. Red. So all I can say is tune in next week. Hopefully we get some more clarity and try to get off screen during these bloody days. Like tomorrow,
take a break.
It's going to be a bloody day, and I'm going to be touching grass. I'm going to try to touch grass somewhere just to just take that break. So thanks everyone for tuning in. Until next time.